Hello and welcome back. You are on part 5 of how to reduce or eliminate your capital gains tax. And if you've made it this far, congratulations. Because most people, when it comes to this kind of stuff, they get teary-eyed, glassy-eyed, and probably would rather just, walk across broken glass and bare feet than listen to this stuff. But when you understand how much it can save you and how much you can be ahead by holding on to more of your money instead of giving it away because of just tax mistakes, it becomes a very valuable exercise. So let's get into part 5. Okay, what you're going to learn. Well, what you've learned so far is how to time your capital gains so that you can get into a zero bracket or close to a zero bracket. I taught you how in part 2 how to use paper losses to do basis laddering to save on taxes on any position. In part 3, I taught you how to do pure loss harvesting. Part 4, 664 trust, and we are now finally on to part 5, how to protect against those hidden taxes and do what I call strategic loss swapping. So before we waste any more time, let's get right into the nuts and bolts of it. Basis rules. So when you have an IRA, you were always taught, hey, save and defer as much as you can. I mean, no kidding. You walk in any grocery store and you see Kiplinger's, you see Money Magazine, you see Forbes. Splashed all across the front pages are save more money to your IRA, save more money to your 401k. Well, from a guy that's been doing this 4 decades, I get a little skeptical when you open up the pages of those magazines and you see a full page ad from XYZ 401k. They might be paying $250,000 in advertising that 401k for just that page. And so a lot of people think, well, I want to defer as much as I can. That is not always the wisest thing because remember, anytime you defer, there will come a time where you've got to pay the tax. If you don't, then your kids will or your beneficiaries will. And that's a very dangerous thing because as you let something grow, when you are in the US under a progressive tax bracket system, the more you make, the more you pay. So the more you let it defer, the higher the tax is. When you were sold on this idea of deferring as much as you could into IRAs and 401ks and retirement plans, the goal was people would say, well, you defer it when you're in a high bracket and then you take it out when you're in a low bracket. But here's the problem. If you look at the tax brackets since they went into effect during the Civil War, prior to Bill Clinton getting into office, they were up in the 70 to 80% range. 70 to 80%. After Bill Clinton got in, they came down to the lowest period in history. Now, back then, they created 3 separate tax brackets. And then the government got really smart. They figured out how they were going to collect more tax. In the higher bracket, all that they did is they spread the bracket wider. And what that simply means is that when you spread a bracket wider, it's going to catch more people in the higher bracket. Now, since the 90s, that has been changed a couple times. It went to 5 brackets and then 7 and then all. So it's been changed. But the bottom line is this. Deferral is not all it's made out to be because when you go to pay the piper, you got to take that money out and it's taxable. Now, there is something on a retirement plan called an RMD, required minimum distribution. Well, it used to be at age 70 and a half, you'd have to start taking your minimum distribution. It was usually about 5 to 6% per year. And in Secure Act 1.0, it was a congressional law that went into place in 2020. And then the subsequent Secure Act 2.0, which went into play 2023, January. That changed how the RMDs worked. Now what happens is between the 8, it depends on what your birth date is, but it starts between 73 and 75. So the older you are right now, you might hit that 75. The younger you are, it may or may not. So in short, it's not 70 and a half anymore. But either way, at age 73 to 75, you must start taking money out of your IRA, 401k, whatever kind of retirement plan. It could be a SEP, a SERP, UniK, it could be a simple plan. Basically, anything that you put away before tax is going to fall into this new rule. Okay, so in order to satisfy your RMDs, and I'm going to use something that's not mathematically correct, but here you're just here to learn concepts. So you got $1 million. Let's say you're 73. It's going to be about 5%. I'm rounding. So you've got to take out $50,000 the first year. Problem is, that's all taxable income. If you watched my part 1, I went through how these little hidden and trigger taxes catch up with you, how you end up paying higher capital gains tax, how you pay penalties on Medicare, how you actually increase the tax on your Social Security. And what do you think an RMD does? It does that. It actually increases the tax on your other incomes because it's pushing that income out to you on a fully income taxable basis. Okay? So you don't have to, let me clarify something else. You also do not have to satisfy your required minimum distribution by cashing it out. Now, I will tell you 99.9% of every financial planner, financial advisor, bank, broker, custodial accounts, when you call them up and you say, hey, I need to satisfy my RMD, and they tell you, well, it's 50 grand, and you only have $5,000 in cash, what do you want to liquidate? And most people just say, well, liquidate X, Y, and Z, so it's turned into cash. But that could be one of the biggest mistakes you ever make. And here's why. When you liquidate to cash, you might have some positions that you want to bring out and you don't want to sell. Because one of the bottom lines is stock is a terrible tax consequence when it's inside of a retirement plan. So what is the downside on waiting to just get to the age of RMDs? Because that's what a lot of people do. They're like, yeah, Ken, listen, everything's good. I'm 65 right now. I don't need to start taking money out until 73, 74, 75, whatever it is. I'll say, here's the problem. If your money doubles, let's say you've got $1 million in there right now, you're 65, and if it doubles by the time you're 75, now you got $2 million. Now, instead of being responsible for $50,000 in forced out taxable income, now it's $100,000. So taking into account we are in a progressive tax world in the US, that's not going to do you any justice. That's going to take away more money out of your pocket. In addition, when Secure Act 2.0 went into effect, they gave something and they took it away. What they gave is a longer RMD age from 70.5 to 73 to 75. But what they took away was the ability for the beneficiaries to stretch out. You might have heard this term in the years prior. It's called a stretch IRA. Mom and dad die, they leave it to their kids, and then their kids don't have to take money out in the normal RMD age. They could spread it out over their life expectancy. So if mom and dad died in 70 and the kids were 40, then you've got probably 30 to 40 years of life expectancy. It's not a big tax bite because you can take it out over a longer period of time. When Secure Act 2.0 got passed, January of 23, that all went away. You can no longer stretch any retirement plan. If you die now, your kids, beneficiaries, must, it's not based upon their age anymore. They must just take it all out within 10 years. So you can imagine, like you say, okay, I'm 65, I got $1 million in there. I'm going to let it defer for another 10 years. Now I'm 75 or 75. I got $2 million in there. I die. Now I leave $2 million to my kids. Now they don't have an RMD of $100,000 a year. They have an RMD of $200,000 a year because they got to empty that bugger within 10 years. That's a horrible tax outcome for the small benefit of possible deferral. Now, you know what I found? And this is what's great, is I listen to these politicians, and I don't care who's in office. They all say they're going to lower taxes. But you're talking to a guy that actually does the tax preparation. And every time I do a tax return over the years, I look and go, these people aren't paying any less in tax. They're actually paying more in tax, even though the politicians are all up there on their stump saying, oh, we lowered your taxes. No, you didn't, because I'm doing the returns. Because whatever they give on the front end, they take away something else, and usually something more on the back end. So let's talk about Roth conversions, because a lot of times people will call up and they'll say, well, I don't think I should do a Roth conversion. Well, how did you come to that conclusion? Well, I called my CPA, and my CPA said, I shouldn't do that because it's better to defer the money. And I ask, how long did it take that CPA to come up with that conclusion? And the client says, well, what do you mean how long? Like, you asked that CPA. How long did it take them to come up with the answer whether you should or should not do a Roth conversion? Well, they told me immediately. Well, how could they tell you immediately? It takes our office 2 to 3 hours to do a proper Roth conversion analysis and schedule everything out, plan it all out to get the minimal amount of tax, and then make the determination whether you should do it or not. And I will tell you, out of every 10 Roth conversion analysis that we do, here's what we have found statistically. 3 out of those 10 people we tell do not do the Roth conversion. It is not advantageous to you to do it based upon the schedule of taxes, the bracket you're in, the income you earn, the deductions you have. However, 7 out of 10 people, actually, it is to their benefit to do a Roth conversion. Now, in most cases, it's not to their advantage to do the Roth conversion all in 1 year. So this is why we want to catch somebody as early as we can so that we can start moving money out of IRAs and 401ks into the Roth accounts. But that takes strategy, and it takes tax minimization ideas, which I'm going to cover with you right now. That's good news. So there's another confusion out there. There used to be, and I'm talking like 15, 20 years ago, long time ago, there used to be a maximum of $100,000 a year of adjusted gross income before you could convert a Roth. Well, they did away with that. I don't remember when. It was more than a decade ago. So it hasn't been there, but some people still come in and say, well, I don't want to do that because I make too much money. I don't qualify for it. Listen, there is no income cap anymore. You could be making $20 million a year, and you can still convert to a Roth. Now, the downside is you're going to pay the tax on it when you do the conversion. But again, that's why you have to do the calculations to figure out, is it better to convert now, pay the tax, maybe convert a little bit over a period of time, pay a smaller amount of tax? Well, I'm going to show you a strategy as how you can start converting over a period of time using losses. Okay, I do need to tell you first that when you do a conversion, if you cannot use your RMD, so using the example $1 million, you got $50,000 a year in RMDs, that 50 grand you cannot convert to a Roth. Now you have to take it out. Now you don't have to take it out in cash. If you have some positions that you don't want to leave in the IRA or in the 401k, you can physically take those positions out, and the value of those positions on the day that you take them out is what goes towards the total calculation of your RMD. So I'll give you an example. Let's say you have $50,000, but you have a stock that you spent $200,000 on, and right now it's only worth $50,000. But you know it's going to go back up, whatever happened to it. You have that good feeling about it. So you take the stock out. The tax cost is the $50,000. You don't have to sell it. You just move the stock out and you move it into your non-retirement account. Why? Well, as we'll talk about as we go through this, you cannot use your RMD to convert to a Roth, but you can take the positions out to satisfy the RMDs. And you do not want stock. Well, I don't want to say it that way. Sometimes you have to have stock in an IRA. It's just not optimal. But my point is, you cannot use your RMD to do a Roth conversion. However, if you're working or you have a business, you can, in fact, utilize a new Roth contribution with some or all, depending upon the size of your IRA, into a new Roth. Okay? So let's talk about stock in a retirement plan. So we see that investment companies, we talked about that, the magazines that have all these covers, and they talk about the optimal selection of what you put in to a retirement plan. Well, if we think through, and I'm going to use an example. Now, this is like in a perfect world, and there is no perfect world, but maybe this will make sense. You got $1 million. You have $500,000 in your retirement plan. You have $500,000 in your non-retirement plan. And you have decided that what you're going to do is you are going to have a 50-50 stock bond mix. So let's cover what, how, and when do stocks get taxed. Stocks have their own tax deferral. So if I buy a stock at $10 and it turns into $100, I don't pay any tax on that gain. Now, the politicians under the recent administration wanted to tax gains that way. So if something went up, even though you didn't cash it in, that got killed. I don't think that's going anywhere. But it's a deferral system within stocks that's inherent to stocks. Doesn't need to be in any kind of special plan. You can buy a stock at 10 bucks and just wait till it gets to 200. You don't pay any tax on it. You're only going to pay the tax when you sell it. Here's the difference. When you sell the stock and it's not in the retirement plan, you're eligible for capital gains tax. And the capital gains tax, when we look at it, I mean, you can get 0% up to 80 grand of total income, even 15% up to $500,000 in income if you're married filing jointly. I'm rounding this. This is just an example. Or only 20% up to $500,000 if you're married filing jointly, or over $500,000 in total adjusted gross income if you're married filing jointly. So the tax rates, not always half, but I'm just going to use that categorically as we have this discussion. But tax rates are typically on capital gains tax, they're about half of what they are on ordinary income tax. Unfortunately, when you buy stock inside of a retirement plan, it does not become eligible for the capital gains lower tax. Now, if we look at a bond, and a bond over the last 30, 40 years has an average rate of return of between 5 and 6%. If you invested in the S&P 500 over the last 50 years, it's over 11%, almost double the rate of return on bonds. So what I find disturbing is a lot of money managers, you go to them and you say, listen, I want 50-50 stock bond. And let's say we use that example where you have $1 million, 500,000 in an IRA, 500,000 in a non-IRA. And so here's what almost every money manager does. They go into your IRA, they build a model, they buy 50% stock and 50% bonds in your IRA. And then they go to your non-IRA, same model, 50-50, they buy 50% stock, 50% bonds. So let's think about how that actually hurts you. In the IRA, the bonds have a lower growth rate. And we've learned tax deferral isn't the greatest thing, especially when you retire. If your IRA doubled and doubled and doubled again, it's only going to double your tax every time it doubles. So if we put something like a stock in, that let's say you're using an S&P 500, let's just say as an example it has 11% rate of return. What happens? Well, now you've got a giant IRA that you got to deal with, a giant income tax, a giant required minimum distribution, a higher tax bracket, and the kids have to deal with it at death. If the bonds were in the IRA, that only pays interest and it has minimal growth. Bonds are there for the safety. So we're making the presumption. You're not making a decision on your investment allocation by taxation. You're doing it based upon risk. So you've decided 50-50 stock bond. Okay. So now you put 50% in your IRA of stock, 50% IRA bonds. Now let's look at the downside of having the bonds in the non-IRA. The function of bonds is they're not tax deferred. They pay interest every single year. You can't say, well, I don't really need that money and I don't want to pay the tax on it, so don't send me the interest. When you own a bond, they're going to send you the interest. You pay tax on it every single year. Now, let's just use the presumption that you were 50-50. Why not have all of your bonds in the IRA? It will prevent the massive growth and tax problem, and have all your stock in the non-IRA. That way you can control the capital gains. Even if you sell it, it's going to be a lower tax. So let's jump over this hump first about tax deferral is not the greatest thing, well, number one. And number two is optimally stock is not the best in a retirement plan. It's better in a non-retirement plan. And it's best in a Roth if you can get it there. So question is, how do you get stock out of a retirement plan? Well, when an investment drops in value, now again, I'm putting the little caveat in here that I don't know if you're over RMD age and you got to meet RMD, or you're under. Now, if you're under, you got a great opportunity. If you're over, it's a little less optimal, which is why I tell everybody, make sure you plan for this far in advance. Okay, let's look at what we call a low value swap. I'm going to use an example. Now, IRA, your IRA, whoever's IRA, it buys 1,000 shares of Rivian on December of 2021 when they went public. And the price was 120 bucks. Yeah, it fluctuated, went up to 136 that day, but we're just going to say for the heck of the example, it's at 120 bucks or a total cost of $120,000. And the current price, let's say it's $10.28. So the value today is only $10,280. That's a loss of $109,000. How do we capture some benefit from that. Okay, here's what we're going to do. Step one, we're going to move the shares from the IRA, the Rivian shares, to a Roth. It's just a Roth conversion, but we're not going to cash out the Rivian. We are simply going to move the shares. Most brokers, again, they don't know how to do this. They'll say, oh, you want to fund a Roth conversion, you got to sell assets, you got to sell it to cash. No, you don't. It's a two-step conversion. First, you move the shares. Okay? Two is you calculate the average price of that share for the day. That determines whatever your taxable conversion amount is. So what you do is step two, I'm making the presumption here that you're going to hold Rivian for the long term. So you let that Rivian stock at $10.28 sit in there. Now, if I use Tesla as the example where it sat there flat and then it dumped down to the floor and then it went up, and but there's been billionaires that have been made by Tesla stock for holding on to it for 10, 12 years. So I don't know. I'm not endorsing Rivian by any means. I'm just using this as an example. You convert the money from the IRA to the Roth, right? It's a $10,000 cost. So if you look at let's say that the Rivian stock goes to $230 a share later on. So now you've converted it for a cost of $10,000. Let's go back a little bit and I'll show you where that is. So $10,280 is the cost. No, it's not the tax cost. It's the taxable income. So depending upon where you are, you might not pay any tax on the conversion at all, or you could pay up to, say, $3,000 if you're in a 30 to 35% tax bracket. So let's look at it again. Just review it real quick because I'm going quick. One, you bought the Rivian stock for, say, $120,000. It's now worth $10,000. Here's the downside. You can't sell a stock. That's the other disadvantage of stock in an IRA. You can't sell it inside of an IRA and take a loss anywhere. Doesn't help you. You can't get the deduction. You just take it in the neck without any kind of future benefit. So assuming you're at a loss, but you want to hold on to the stock or the position, convert it to the Roth. Whatever the value is what you pay tax on for the conversion to get it out of the IRA and go into the Roth. Now, let's just use an example. And I don't know, I'm not saying Rivian's going to go to $230 a share. I probably should have used Tesla stock as an example, but let's say it does go to $230 a share. Okay, so now what happens is that $10,200 was converted. That was the value. You paid tax on it. But what happens now is the Roth has the $230,000 in it. So 100% of all of your Rivian stock is completely tax-free, 100% tax-free. So in this example, if you left it in the IRA and it turned into the $230,000, now let's say that you are having to take RMDs, and let's say you're in a 20% tax bracket, that's going to cost you $46,000 in tax, either once or over time, or your beneficiaries. You can't get around it. So that's a big tax compared to the $3,000 it might have cost you to do the Roth conversion. Number two is, let's say you're in a 35% tax bracket. Now it's going to cost you $80,000 to get that Rivian stock out of the IRA versus swapping it when it's at low value into the Roth, doing the conversion. Okay, so it's a huge, huge saving. So let's just review real quick. Oh, hey, before I do that, I got to throw this in there. Please subscribe to the channel and notifications. As I'm coming out with these series, if you subscribe and you notify with the little bell, it'll tell you when I produce another episode so you can stay in alignment with all these different educational courses that I'm doing. And it also helps build the production. So we're funding all of the video, the editing, everything else with no cost to you. So the more you subscribe, the more we can produce and educate you and get you ahead financially. So going back to content. So the part that we covered already was in part one, we talked about how to reduce the tax to zero using 0% capital gains. Part two is basis laddering. Part three was true loss harvesting. Part four was 664 trust. And we capped it off today with loss swapping and discounted conversions. Hey, if you want help with this kind of calculation, go to our website. It's onewealthmap.com. There's a little form on there. You can click on it. You can call. You can sign up. And we can do these calculations for you and show you if you are missing out on opportunities. I hope you've enjoyed this 5-part series and you've gotten something out of it. And hopefully you'll be ahead better financially. Have a great day.